In this video, we're going to look at a trading strategy suggested by a viewer of this channel. The strategy is quite simple and it uses just one moving average for the entry signals. David didn't suggest a particular Forex market to test this strategy on, but he did suggest that it works on the daily time frame. I'm going to be using Multichart's Portfolio Trader, which allows me to quickly run tests across multiple markets using that same strategy. So once I've programmed the rules for the strategy into Multicharts, I'm going to be conducting tests across 14 of the more heavily traded Forex markets to see which market this strategy might be best suited to. Hopefully, by the end of the tests, we'll have a profitable strategy which we can apply to a few different of the Forex markets. I have price data for the 14 Forex pairs running from the 1st of January 2008 through to April 2024. So over 16 years worth of data, and that data is plugged into Multicharts, which is coming from Oanda. As usual, we'll have a quick chat about the strategy rules so you know exactly how to get in and out of the trades, and then we'll move over and go and have a look at the results in Multicharts. Then, as a bonus, I want to see if I can make further improvements upon the original strategy. Okay, trade entries then. We're going to be looking at the daily chart and we're going to be using a 5-period simple moving average. Once that's on the chart, we look to see if the close crosses below the 5-period simple moving average, then we buy on the close of the bar. And of course the opposite is for short trades. If the close crosses above the 5-period moving average, then we short on close. Trade exits ever so easy. Exit number 1 is stop and reverse. So what that means is if we're in a long trade and we get a signal to go short, then we exit the long trade and we open a new short position, and vice versa. Exit number 2 is a timed exit, and it's simply stay in that trade for 5 days and then exit on the close. Let's look at an example. Here's quite a good example. We can see the cyan moving average, and we can see that only one of these trades actually uses the timed exit. We look at them one by one. The first one here, we see the close has crossed below the moving average, so we buy on the close. The next bar, the close crossed above the moving average, so we exited the long trade and we entered a short trade. And then we were in 2 bars later, the close crossed below the moving average, we exited the short, went long, and then as we can see, we've got another 1, 2, 3, 4, 5, 6 trades like that until we finally buy when the close crosses down below the moving average. But then we didn't get a stop and reverse exit. The close didn't go back above the 5-period moving average, but we did stay in the trade for 1, 2, 3, 4, 5 bars, or 5 days in this case, and then we exited the long trade, and then we would have been flat. Now you'll notice that I said in the entries we want to be looking at the close crossing either above or below the moving average. Now why are we using close crossing rather than close above or below? This is a question I've had quite a few times, and it's very important, especially when we come to program a strategy like this. Let's look at this last trade here, for example. We've got the close crossing below. So what that means is the bar before the close was above, and now we've crossed below and we've closed below. That's our entry signal. You could also argue that we could have said, why not just say if the close is below the moving average, and in this case that would have worked. However, if we'd have used that rule and we got out on the timed exit here, we would have immediately entered a new long trade because the close is below the moving average. It hasn't crossed below, i.e. the bar before the close wasn't above the moving average, and then this bar is closed below it. So what we'd do is we'd carry on opening new trades all the time the close was below the moving average, rather than we just want to look on the first bar of the cross, either the cross above or the cross below the moving average. And that's why we use cross in the code rather than above or below. So a simple one to get in and out of trades. Let's go and have a look at the results. This is Multichart's Portfolio Trader, and firstly let's look at the date range, 1st of the 1st 2008 through to the 1st of April 2024. Here's the list of the 14 of the Forex pairs we're going to test, and this is the strategy which we're testing. I've called it JG Demo Average 5 Bar. The results we're going to see are going to be in pips rather than the currency for each of the pairs, just to try and normalise results across all of the currencies. So let's look at the back test. This is the total net profit for that 14 pairs for the whole portfolio. You see it's losing 17,900 pips, so that's not good. That's what the equity curve looks like. But I'm more interested in to see the individual results by market. Here we can see the results by market, and we can see that only 1, 2, 3, 4, 5, 6 of the 14 are actually profitable, and some of them by not very much. Let's have a look at the profitable ones. Australian dollar, US dollar. There's the equity curve, which isn't very good, is it? Euro pound didn't make a lot, and again, not very good. Although it did have times where it was working pretty strongly. Euro, New Zealand dollar, not a very good equity curve either. Pound Canadian dollar, which looks like it's made the most amount of pips out of all of them. And a reasonable equity curve. That's certainly going in the right direction. So that shows some promise. New Zealand dollar, Canadian dollar, not a very good equity curve. Again, had some good periods and some really bad periods, but not smooth across the whole set of data that we have. And lastly, we've got US dollar, Canadian dollar. And again, moving in the right direction, had some better periods and some worse periods. Not a very smooth curve, but is making money nonetheless. Let's also just look at pound yen here, because this is by far the biggest loser. And that's a really nice loser, isn't it? It makes me wonder whether we can actually reverse the strategy rules for this pair and have a strategy which will make money. It probably would, because pretty much anything trend related seems to work quite well with pound yen. At the moment, we're using a moving average length of 5, or a 5-day moving average, but maybe there's a better length. So what I want to do is run a quick optimization across all of the 14 pairs, looking at the different lengths of the moving average. So we can do that quite easily. So we're going to optimize this input, and I'm going to start with a moving average of 3 and then go through to a moving average of 30 in steps of 1. And we're pretty much just looking at net profit. So if we look at the graph, we can see that along the x-axis is our length of the moving average. Currently we're using a moving average length of 5, which is the results down here, which is actually one of the worst. We can see that as we start to go longer, results generally start to get better in terms of net profit, to the peak of about here, which is about 21. So anything from about 16-ish through to 22-ish, that seems to be quite a nice stable area. So let's apply a moving average of 20 and see what happens. Notice we've still got that 5-day exit. Now we can rerun the back test. This is the individual. The total net profit, 3,700 pips, so it is making money this time. Equity curve's pretty terrible. Looking at the individual strategies, glancing at them, it doesn't look that much better than what we saw before, does it? In fact, what I've noticed is it's tended to actually make more money because it's reduced the losses. Look at the likes of pound yen. We're only looking at a minus 4,500 now, whereas it was much, much larger than that before we adjusted that moving average length. It appears that the Canadian pairs, pound Canadian, New Zealand Canadian, US dollar Canadian, they're all still making money. So it looks like this strategy does tend to work best on the Canadian pairs. I wanted to show you the optimization of the moving average length, just to show you what we can do when we're using software like multi-charts. However, in terms of an optimization on a portfolio level or a global level of 14 different Forex pairs, I don't think that's the best use of it, because each of the pairs, they move so differently to one another. We're never going to fit a strategy to work on all pairs altogether. I think the next thing to do is look specifically at one of the pairs to see if we can improve it even further, see if 20 is a good length for that individual pair, and see if the 5-day exit is optimal also. Now, I have already run some quick tests, and I can tell you that although using the 5-day moving average, pound Canadian was the best, I found that adjusting the lengths on US dollar Canadian gave us much more stable results. So that's the pair we're going to look at next on an individual level, just the US dollar, Canadian dollar. Seeing wildly varied results across the 14 Forex pairs is not uncommon for any one single trading strategy. If anybody tries to tell you that they've got a rule-based trading strategy which works on any or every of the Forex pairs, then be extremely wary. At the very least, test that strategy out for yourself before you start to trade it. In all the years that I've been developing and testing trading strategies for the Forex markets, I've never found one single strategy which works across all of the Forex markets equally. The individual Forex pairs move quite differently from one another. Some are quite trending and some are quite mean reverting. So applying a trend following strategy to a pair which is typically mean reverting is just madness. And that's why the vast majority of my trading strategies are market specific. They look at the individual markets and they exploit the edges in those individual markets. And it's very rare that that specific edge is going to work equally across any of the other markets. If you'd like to see some more of my trading strategies, then you can get my 22-page Beat the Markets Strategy Guidebook. In that guidebook, I've put in 3 more rule-based trading strategies. And at the moment, you can download it absolutely free if you find the link in the description down below. And if those 3 strategies aren't enough, then you can get another 6 of my strategies, along with a lot of other modules in my popular trading course. If you'd like to find out more about the trading course, then I'll also put a link in the description down below. Okay, let's now go and have a look in more detail, this moving average strategy applied to US dollar, Canadian dollar. Now we've got just US dollar Canadian selected in multi-charts. I want to run an optimization again on the moving average length to see if 20 is the best. But what I'm also going to do is actually remove the timed exit, just so we get a better picture of what lengths works best without introducing more variables into the equation. So we're going to optimize the moving average length from 3 through to 50 in steps of 1. But instead of having a bar exit or a day exit of 5, we're just going to increase that to, let's say, 300. So we're not going to be using any sort of an exit at all. We're just going to be using the stop and reverse exit. This is going to give us a better idea of what moving average length is most stable. And here we can see the moving average length of 5, which was our original. It produced profit here. And then we very quickly go up when we get to length of about 11 through to about 22, 23. So yeah, sure, this is a stable area. So 20 is definitely a stable value for the moving average length. So let's stick with 20. And I think we've already seen the results individually. Well, this is 20 with no timed exit, so this is just the stop and reverse. That's what the equity curve looks like, making 8,500 pips. But now let's look at that timed exit, see if there is a better exit than no timed exit at all, or the original 5 days. And now we're going to be keeping the moving average length at 20. So we got a timed exit of 1 to 50 days in the trade in steps of 1. And we can see that along the x-axis, this is days in trade. We can quite clearly see that right up until about here, what's that, 24 days, 25 days, that we were making more and more money the longer we stayed in the trade. And then the results pretty much just flattened off. And the reason the results flattened off is because after about 25 days, it was unlikely that we were going to stay in the trade more than 25 days without getting a reverse entry. So it's unlikely that we're going to be in a long trade for more than 25 days without getting an entry signal to go short. So anything above about 25 days, we're not going to be using the timed exit at all. We're just going to be getting entries and exits through the entry signals. So looking back at the spreadsheet, we can see that the bar's in trade down here on the right hand side, and we've got net profit here, average trade value is here, percent profitable. Again, percent profitable goes up as well as the net profit. right up to the maximum value, which looks about 24 days. So in terms of net profit, percent profitability, average trade value, the longer we stay in the trade, the better. We've already seen a similar equity curve when we selected the 300 days. This is now looking at 24 days. Here's what the equity curve looks like, which isn't bad. But you also probably want to see the original 5-day exit using the 20 period moving average. And that's what the 5-day exit looks like. So the good news is they do all make money. But just to recap on our results, looking at the bars in trade down here, the longer we stay in trade, the more net profit, the higher the percent profitable, and the bigger the average trade value. Using the moving average as our signal to get in and out of trades, like we've seen in this strategy, is profitable on some markets, especially US dollar, Canadian dollar, but it's not the best, is it? I've never found the use of moving averages to work the best on most of the Forex strategies that I've looked at. I much prefer using things such as the highest highs or the lowest lows over the past X number of bars. Or, as we saw in my last video, looking at the highest close over the last X bars or the lowest close over the last X bars, 10 bars, 20 bars, for example. In my testing, I've always found that approach works better than using moving averages. But the purpose of this video was to test David's strategy across those 14 Forex pairs on the daily time frame. And that's what we've done. So I hope you found the video interesting. What we could also do next is apply the same strategy, test it across the same Forex pairs, but on different time frames. Perhaps the daily isn't the best, and perhaps something like the 4-hour time frame might work better. Let me know in the comments if you'd like to see those tests. But for now, that's all for this video, so thanks for staying till the end, and I hope you have enjoyed it. If you have, then please give the video a thumbs up. I hope I'll see you in the next video, but until then, this is Jared Goodwin, and thank you.